Okay. All right. So I wanted to go over some of the homework. Number 6 was one of them. Is there another homework problem that you guys want to go over? None? Everybody's good? Okay. So, sorry. So let me go over number 6. Let me go over the screen here. All right. So can everybody see the screen? Can anybody not see number 6? Fantastic. All right. So we have the capacity to make 10,300 webcams. And this is important because if we didn't have the capacity to make them, then it wouldn't even be relevant. So here are the variable and the fixed costs. So they're currently purchasing 5,400 of the same type of webcams each year from an outside supplier at a price of $51.61. So what would happen if they made the webcams and sold it to the other division? So they would end up spending, since they're already making them, the fixed costs are going to be irrelevant. They're only going to worry about the variable costs in this case for the additional, what was it, 5,400 cameras that they have to make. So you'd want to take your variable costs and then multiply it by the 5,400 as long as you are under capacity. And then, does a reasonable range of transfer prices exist? No. The variable cost is 28. They're making them for 51.61. If you add these two, what is that? 28, 38, 43 is what it would cost. So again, they're not going to be winning anything by doing this because of the capacity issue. And then number C, or B2, sorry. So the Langford division increases production so that it could use the 10,300 webcams. How would the change of volume affect the range of transfer prices? So now capacity does make sense. And so you have the 43, which is the variable and the fixed cost together. That would be the minimum that you could charge the other division. Otherwise, that first division would be losing money. It wouldn't make sense. And then the maximum would be 51.61 because that's what they're already paying. They wouldn't pay any more regardless of where they get it. That doesn't make sense. So the negotiated price would be somewhere in between. Are there any questions on that? Okay. So there's, sorry, my obnoxious dog. Somebody's coming up the stairs. So are there any other homework questions you guys want to go over? Okay. So what I'm going to do is start, let me talk about the exam for a second. The exam is open. Hold on. Are you done? Okay. So the exam is open. You have 75 minutes to take it. You can use your textbook. I've taken it and it has worked for me, but there's a part of me that's like, something is going to go terribly, terribly wrong. So if you run into problems, please let me know as soon as possible so that I can try and fix whatever I can with that. 29 questions. So again, if you have any issues, let me know. Okay. Are there any other questions about the exam? Any other issues? Okay, so let's go ahead and start chapter 10. There is a fair amount of chapter 10 actually that we're going to be skipping, and I will show you why in a second. Okay. So we are going to be talking about capital investments. Capital investments essentially are the large assets that you're buying, and the only reason that you would buy these assets is so that they make money for you. So we're going to look at sort of how a purchase of an asset gives you a certain return. Okay. Hold on a second. Yes, open book. Okay, so let's talk about capital investments. Okay. I'm going to talk about time value of money. However, we are not going to be calculating time value of money. You guys have done it before. You did it in 204. This is not the last time you're ever going to do it. There's software that does it. I don't think we need to talk about how to calculate time value of money. I want you to understand what time value of money is. I want you to tell me the pros and cons of calculating the time value of money, but we're not actually going to have to calculate it for chapter 10. So a lot of chapter 10 is calculating it, and we're just going to skip it. Okay, so again, we're talking about long-term assets. We're going to have them for a while. We need to see how the purchase of a long-term asset is going to help you earn income and basically make a decision on purchasing a long-term asset. Okay, so the whole point of time value of money is that $1 today is not worth as much as $1 in the future. And so there's a very specific calculation in order to figure out how much $1 5, 10, 15 years from now is based on inflation or based on interest. When you purchase an asset, you should have in your head, really? Okay. You should have in your head what the amount of return you want. I can't do this right now. My kid and my husband are in the kitchen right in front of me. It's very distracting. Hold on one second. Yep, no, oh, yep, no. They're spilling water all over the floor. It's fantastic. Sorry. Fortunately, this chapter is gonna be really short. Hey, it'd be great if you guys could go downstairs when you're done. No, no, that I can't ignore you. That's no, can't do it. I can't ignore you. Okay. Sorry, back to, so you have a minimum rate of return. So when you're buying an asset, you should be like, hey, I'm going to spend X amount. I expect to receive a return on this in the form of income, net income, at X%. So creditors expect an interest payment when you get a mortgage, when you get a car, and you're making those payments. A large portion of that is interest, right? And then you reduce a little bit of the principal each month. And then owners expect dividends, and we talked about dividends in financial accounting. So owners expect dividends or an increase in stock value. So all of that is considered when you're talking about what is your minimum rate of return. So if you yourself want a 10% minimum rate of return, what is that on top of the interest payments that you have to make and on top of what dividends or stock prices are going to do? So this is an example of what they're looking at for time value. So they have 178,571, and they require a return of 12%. So again, that's what investors and stockholders are looking for, plus whatever interest or return you are expecting. So you're going to divide, they want a 12% return, so you're going to have to take that investment, and I guess your original cash flow was 200, so you divide it by 1.12 and you get an initial investment of 178,571. Again, we're not going to have to calculate this, just understand how it works. So these are the tables you guys use in 204. You're not going to have to use them. They are in the back of the chapter. I don't think there's any homework that requires this. If there is, let me know and I'll just take it out. And again, this is something that we talked about in 204, an annuity. So the difference between what we just talked about and then an annuity. Annuity is just payments that you make every month. So if you think about like a 401k or any other type of investment that is taken out of your paycheck or that you're making equal payments of, so $200 a month or whatever goes into that, that's an annuity. So that's a little bit of a different calculation. It's obviously going to be higher because you're adding to it every month or every year. So this is the calculation for that. Again, you're not going to have to calculate that. Understand what an annuity is, and the difference between that and a single payment. And those are your present value tables. Again, you're not going to have to use them. And we did do this in 204. I don't know if you remember, but there's in Excel you can do present value, and then there's just different software that'll just do it, but that's all it does. But again, we're not going to have to worry about that. Okay, so let me go back for a second and just understand sort of the difference. So the annuity assumption, what we're talking about here is whatever interest or dividends that you make gets reinvested. So that's a little bit of a different calculation. Okay. Net present value, again, we're using time value of money. I don't need you to calculate it. I just need you to know what net present value means. So let me go back up. Oh, that doesn't give you a good example. So it's the present value of an item. So let me go down here for a second. So this is making a decision. So should you buy a piece of equipment based on what you think the future cash flows are going to be? So the present value of your future cash flows. So for example, I guess in this instance, for the next 4 years, you're going to get $200,000 each year. So you're going to get a total of $800,000. The present value of that $800,000 is $607,470. Okay. The cost of your investment is going to be $582,742. So you have a positive present value. As long as you have a positive present value, that is a decision that you can make that you should purchase that. You're going to make income from that piece of equipment or project or whatever it happens to be. So again, it's the present value of all the future cash flows subtracted by the cost of your investment. Cost of your investment, you don't have to do any calculation for. That's current. You currently have to pay this amount. Okay, so if it's positive, you're going to say yes. If it's negative, you're going to say no. Any questions so far? I think you guys have already seen all of this. Okay. For the exam, I would say some good sort of conceptual questions are, what are cash inflows and what are cash outflows? So make sure that you know what would be considered an inflow and what would be an outflow. So cash inflow is any cash that you have that would be coming in. So when you sell it, the salvage value your cost savings. Even though cash isn't coming in, you're still saving money. So that would be a cash inflow, revenue, and then release of working capital. And then cash outflows. Again, cash going out. So you have additional capital commitments, your initial investment, your down payment or your purchase, and then whatever increase in expenses that you have. So this gives you an idea of your cash inflows and outflows. Okay, so again, just make sure you understand what's an inflow, what's an outflow. This just compares the two investment opportunities. We don't need to really talk about that. We're going to skip a lot of this net present value calculation stuff. Also going to skip a lot of this present value stuff. I do want to talk about internal rate of return. We are not going to calculate it because it does require present value, but I want you to know what it is. So it is the present value of cash inflows, and they must equal the cash outflows. So the investment cost, an investment cost 582,000, and will return 200,000 at the end of each of the next 4 years. So it's going to give you the present value for all of your cash inflows, and you divide that by your initial 200,000, which I think was the purchase. I'm sorry, the return. Ugh. So if you look at, that's not a good example. So once you get your decimal factor, then it's going to give you the rate of return, your internal rate of return. So again, you're going to take your present value of your cash inflows, and you're going to divide that by your cash outflow, and that's going to give you a decimal, which gives you your rate of return. I'm not going to have to calculate it, but make sure you understand when we go back what your internal rate of return is. So it's a comparison of the cash inflows and the cash outflows. Any questions on that? Don't worry about irregular cash flow. Just know what the IRR is. Okay. We're going to skip most of this. So just ignore this. Let me talk about the tax considerations. I think this is something that a lot of people forget about when they're looking at investments or anything else. When we are looking at cash inflows versus cash outflows, there are two tax considerations. One is depreciation, which lowers your tax, and the other is your after-tax cash. So that's what your income, after your income taxes have been paid. So two things to consider. So your depreciation, it's a non-cash item again, and we've talked about this before. You have depreciation. You don't actually pay 1,000 or 5,000 or whatever in depreciation, but you get to deduct it from your income, so you don't have to pay tax on it. So depreciation is added back when we're talking about sort of the after cash tax flow of it, because it's a non-cash. Just like we did in a cash flow statement, we added it back because it's something that you subtract out of your income statement that is not an actual cash transaction. The only cash flow impacted is the reduction in income taxes payable. So because you have that depreciation, you have a lower tax dollar or tax payable in this case. So again, we're not going to have to calculate this, but understand the implications of your taxes. So all of the considerations here, your depreciation, and what happens with depreciation to your income tax. Any questions on that? Okay. right, so finally, we're going to get down to some of the non-present value items that we're actually going to do some calculations with. So we're going to do payback method and the unadjusted rate of return. These are pretty simple calculations, so don't overthink them. They ignore the time value of money. This is something that you can do just like on the back of a napkin, sort of figure out what your rate of return is going to be. So the first one, the payback method, very simple. It's just going to be the net cost of the investment divided by your annual net cash flow. This is going to tell you how long it's going to take for you to get your investment back. So for example, let's say that you are interested in buying real estate and then running it out. So you're going to take whatever your down payment is, and you are going to divide that by your annual cash flow, net cash flow. So if you net $200 a month, your annual net cash flow would be $2,400. So it's going to tell you how long it's going to take to get your money back. So they purchased a piece of equipment for $100,000. It will reduce labor costs by $40,000. So even though you're not physically getting $40,000, because it's reducing your cost, it's still going to impact your net income. So it's going to take 2.5 years to get your money back from that investment. So everybody okay with that? Okay. Now this one is assuming that it's the same amount every year. Not terribly realistic, but if you have unequal payments, there are a couple ways to do it. One is you just subtract every year. So you're going to take your initial investment, and then the first year you're going to subtract 3, the second year 1, and so on and so forth until you get to 0. So then after year 3, you have basically broken even. Essentially, you've returned that investment amount. And then the other way is to just do an average. Neither one is better than the other, but all they did was they just took an average of your cash inflows, and then you can use that to figure out how long it's going to take to pay that back. Okay, so guess what? We're going to do some examples of that. Okay. All right, if you cannot see the exercises, let me know. I'm not sure we need to do this, but I want to make sure that you know how to do this. So take a look at this on your own time and make sure that you're okay with the inflows versus the outflows. Okay. So the first one we're going to look at, again, because we're skipping so much of this chapter, is exercise 12. So the company has the opportunity to purchase one of 2 different airplanes. So the first airplane costs $12 million. It will enable the company to increase its annual cash flow by $4 million per year. The plane is expected to have a useful life of 5 years, no salvage value, so that makes our lives easier. The second plane is $24 million. It will enable the company to increase cash flow by $6 million per year. This has an 8-year useful life and no salvage value. So let's figure out what the payback is going to be for each of them. Okay. So the first one, the cost was, well, let me make sure you can see all this. Okay. So 12 million, but you would have the revenue of 4. So it would take 3 years. The second one is 24 million. And you would get 6 back. So that'd be 4 years. So just looking at this, you would choose the first alternative because you would get your money back sooner. So then the second part of this is what are the shortcomings of using the payback method to evaluate this? Obviously, the first one is there's no time value of money considered in this case. But the other one is the life of each of them. So the first plane has a useful life of 5 years and the second one has a useful life of 8. So you can use the second one for 3 years longer than you could the first one. So it's going to earn you $6 million per year more for an additional 3 years than the first one would. So if you look at it that way, the second alternative might be a little bit better. Does anybody have any questions on that? Okay. Why don't you guys, we'll do one very similar to that, which is exercise 12B. So I'm gonna let you do it and we'll talk about it. Okay, so we're talking about some sort of, I don't know, technological machine. So the first one would cost $72,000. But it would reduce cash outflows by $30,000 a year. So the same thing as increasing your income. And then it has a $1,500 salvage value. So let's do it without salvage value first, since we haven't talked about that. So just ignore the salvage value first. And then the second one is $75,600 with an estimated income or a reduction of outflows of $27,000. So go ahead and figure out what those numbers are first, and then we'll talk about what the salvage value is. Also, I'll give you a few minutes. Okay, so the first one should take you 2.4 years to get your money back, and the second one should take you 2.8 years to get your money back. Any questions on that? Does anybody want me to write it on the board? So let's talk about the salvage value for a second. For the sake of just the payback period, it's irrelevant. You're not going to use it for calculations. You're not going to do anything with it. Realistically, however, there are 2 things that you need to take into consideration, which is part B. One is you can use one machine longer than the other, just like in the previous example. And 2, the last year that you have this machine, realistically, you should be adding this salvage value back in as part of your cash inflow. But just for this payback period where we're not worried about any of that, you can just go ahead and ignore salvage value. Okay. Questions? Okay. So the next one I want to do is one that does not have the even cash flow numbers, which is 13. So in this case, again, there are two ways to do it. The first way is just to subtract your cash inflow out every year. So what I would do for this one is you have a cash outflow of 86,000. And so then year one, you have cash inflows because of that of 30,000. Year two, you have cash inflows of 40,000. You're left with 16. Year three, you have revenue of 28 for cash inflows, I should say, but you had a major overhaul of 12,000. So I'm going to add that back because that's a cash outflow. So that equals 0. So at the end of year three, you have basically broken even. You've paid for your $86,000 piece of machinery. Does that make sense to everybody? Okay. The other way to do this is to figure out what the average is. When you're doing the average, you are going to add all of these together, but you need to subtract out this 12,000 cash outflow and then divide it by 5. So that gives you an average of 26,000 per year. And then I'm going to just take my 86,000 and divide it by my average, which is 26,000. So again, for the average, I'm just going to take all of my cash inflows for 5 years, and that includes that salvage value. But I'm going to subtract out the machinery overhaul of 12,000, and then I'm just going to divide it by 5. That gives me the average. So my average is 26,000. Then I can take my cash outflow divided by 26, and that gives me 3.3. So that's a little bit different than what we did when we just subtracted, but it's not a whole lot different. When we're doing just a quick calculation like this, it doesn't make a huge difference. Why don't I let you guys do a similar one for 13A. Okay, so here's your cash outflow, and then you have your inflows. Again, you did an overhaul, and then you have additional inflows. And just as a reminder, year 5, you have 2 cash inflows. One is your regular revenue, and you also have your salvage value. So in this case, we're taking into consideration our salvage value. So go ahead and calculate it both ways. Calculate it with just the subtraction method, and then go ahead and do the average. Okay. Any questions on that before you get started? Okay, go ahead and get started. Does anybody need a little more time? Okay, so your payback, if you're just subtracting, is 2 years. And then your average, so you didn't even have to take into consideration your overall. And then your average is 2.9. So that is a little bit different because it falls off dramatically at the end there. Everybody okay with that?
Could you do that on the board?
Sure. You want both of the methods or just the last one?
Please.
Both of them?
Yes.
Okay. So my initial cash investment was 70,000. My cash outflow. Year one, I had revenue of 40,000. So I still have 30,000 that I need to recover from my initial cash outflow. Year two, I had 30,000. Makes it super nice and neat. So that means after year two, I have recovered my full $70,000 investment. So at the end of year two, I'm going to say I have broken even. I've paid for my initial investment. So that's the first way. The second is the average. So I'm going to take 40,000 plus 30,000 plus 5. I'm going to subtract out that 10,000 that I paid plus 15 plus 10 plus 8. Okay. I'm going to divide this by 5 because I had a total of 5 years. When I figure out the average for that, that gives me 24,100. So that's the average cash inflow per year. So then I'm going to do the same thing I just did, which is the 70,000 divided by 24,100, and that equals 2.9. It truth is not a whole lot different. It's not terrible. Let me make sure you guys can all see that. What do you guys think? Everybody okay? Any questions? All right, fantastic. All right, so let's move on. We might be able to get through this whole chapter today. Should be fantastic. All right. Okay. This is our second part. Hopefully you guys can all see the PowerPoint. If not, let me know. So this is the second one we're going to do, and this is an unadjusted rate of return. This is going to be your average incremental increase in net income divided by the net cost of the original investment. It sounds pretty similar to what we did before. But if you look at the formula, it basically flips it. So this is really just sort of a flip of what we just did. So if we bought a new restaurant, it would be $2 million. Over a 10-year period, the restaurant is expected to provide an average per year of $280,000. So we're not doing the total, we're just doing per year. So what this tells us is we have a rate of return of approximately 14% per year. I'm taking the initial investment, the full initial investment, as my denominator. My numerator is my annual after-tax return. So I have a 14% rate of return, which isn't bad. I don't know what y'all are getting in your checking and savings account right now, but it's pretty much like 0.0%. So 14% isn't bad. Now, here's the fun thing about that. We are not necessarily taking into consideration depreciation here. We're just taking the initial investment cost. So what we want to do is, instead of taking the full cost of the investment, we are going to take the average. To do that or really fast, we're just going to take the original cost of the investment and divide it by 2. What that accounts for, and I would write this down so you don't get confused, what that accounts for is depreciation. Okay, so when you take your initial investment and divide it by 2, you are taking into consideration all the tax consequences and everything else that happens with depreciation. So in this case, so instead, let me go back up here. So instead of 280,000 over 2 million, I'm going to do 280,000 over 2 million divided by 2. Okay. So that is going to give us a higher rate of return. So 100 over 500 essentially, so 20%. All right, so let's do an example of that. Get back to A. All right. I'm going to look at 14 here. All right. So 14A, so we want to buy a spray paint machine that costs $16,000. It's expected to save labor and increase net income by $1,200 a year. The effective life of the machine is 15 years. So let's determine the unadjusted rate of return. And then we'll talk about some of the shortcuts of it. So we're going to take the average increase in income on top, which is 1,200, and then I am going to divide that by my initial investment of 16,000. I'm going to divide that by 2 to account for all my depreciation stuff. So that gives me a 15% rate of return. That's it. Don't overthink it. So shortcomings, it does not consider time value of money. That's the major shortcoming in this. I'm gonna have you try one just for fun. It's, again, it's pretty straightforward. Okay, so go ahead and try 14. So you have a van. It has an average increase in net income of $6,750. So go ahead and figure out your internal rate of return, or I should say rate of return. All right, so hopefully you got 30%. Is everybody okay with 30%? Do you want me to write it on the board? Okay, fantastic. Let's do a super fun one now. I'm going to let you do this. We're going to put everything we learned together in exercise 10-15. We're renting out pontoon boats to customers. We could buy a pontoon boat for $40,000. Oh, let me back up for a second and talk about if it does have a salvage value. If you have a salvage value, you're going to add that into the average of your income. Okay, so it's not going to increase it by a lot, but again, if you have a salvage value, it's just going to increase the average of your net income. Okay, so we have 40,000. It has an expected useful life of 4 years, no salvage, really not relevant in this case. We have a rental revenue, expected rental revenue for the boat is 15,000 per year. So you can do it both ways. So go ahead and do the payback period and then do the unadjusted rate of return. And we will talk about that. And then we're going to go back and talk about a little bit of depreciation. So do it the way that we've done it without depreciation first, and then I will talk about what we're going to do with depreciation. So you should have had a payback period of 2.7 years. Let me know if you want me to put it up on the board. And then your unadjusted rate of return, you're going to do the 15,000 over 40,000 divided by 2. That gives you 75%. Okay, everybody okay with that? Does anybody want me to write it up on the board? Okay, so let's talk about depreciation for a second. PowerPoint really doesn't talk about depreciation. Depreciation is an expense, and it is going to subtract from your revenue. So if we're talking about expected rental revenue of 15,000, what you need to do is you need to figure out what the depreciation is going to be and subtract that from it. So we have a $40,000 boat, no salvage value, useful life of 4 years. So we're going to depreciate it by 10,000 a year, which is just, I'm going to bring this up. 40,000 divided by the number of years of the life. We're going to depreciate it by 10,000, which means that we don't have expected rental revenue of 15,000. We have expected rental revenue of 5,000 net. I'm just taking that revenue and subtracting out my salvage value, or not my salvage value, my depreciation, sorry. So when we do that, instead of 15,000 over 40,000 divided by 2, you have 5,000 over 40,000 divided by 2, and that gives you 25%. Okay, so that is when you have depreciation, that is the correct way to do it, to subtract out your annual depreciation from your annual revenue. Any questions on that? Do you guys feel like you want to do another problem, or are you feeling confident in these two things that we have to worry about in this chapter? Nothing? Okay. So if everybody is okay, then we are done essentially. Again, please let me know if you have a problem with the test. I don't know why I have a weird bad feeling about it, but I don't know. Anyway, let me know how it goes. I'm gonna figure out what we want to do because we're pretty much done with chapter 10. So I'll post something in announcements about what we're gonna do on Thursday. And I think that's it. Are there any questions? Okay, so that's all I have. But please finish the exam. Also, the homework was due yesterday. And again, it's doing something weird where it's showing me that people have not done it. So look at your grade, make sure you've gotten credit for it. If you haven't, let me know. Just send me a screenshot of what you've got and I'll update your grade for that if it's not right. Okay. If there are no other questions, that's all I have. All right. Have a good week. Good luck on your exam. Thanks.